and welcome to Indianomics. The RBI this week raised the repo and the reverse repo rates by quarter basis points. Today we ask whether we need to do away with two signaling rates and do with just one as suggested by the MOHAN panel. Of course, we will discuss the other suggestions of that panel as well. Secondly, the Reserve Bank governor has been lately coaxing Indian banks to lower their net interest margins and improve efficiencies. So are Indian banks making excessive margins and excessive profits? We ask a team of experts. Joining us first on this issue of bank profiteering are SRINIVASAN, the Executive Director of Axis Bank, Professor T.T. Ramohan of IIM Ahmedabad, and ANINDO BHOWMIK, the banking analyst from FITCH Ratings. Gentlemen, welcome. Well, let me start with you, Srini, on this issue. Average Indian bank margins, NIMs, NIMs, have been 3% plus if you take the PSU banks, and if you go to some of the private sector banks like yourselves and HDFC, it comes to 4%. We recently had the Stand Chart IDR. What was the NIMs they were boasting about? 2.2%. So, are Indian banks charging excessive NIMs?
No, I think you'll have to look at it in the context in which banks operate. I think if you look at Indian banks, I think you've got a market in which capital markets are not necessarily fully developed. So to that extent, the composition of loans versus other capital market products are going to be very different. So so to that extent, that is one contributor. The other contributor is also the geographical reach and the operating expenses which banks carry as far as Indian banks are concerned. I think clearly in terms of resourcing, in terms of technology, in terms of every other aspect of operations, I think Indian banks have a lot more to do in terms of making sure that our OPEX is much lower. So right now our operating NIMs is only one parameter. Ultimately what you'll have to look at is net of expense. I don't know about this expenses part because BPO companies are shifting here, banks abroad are shifting a lot of their labor intensive work here, so we should be cheaper. No, one is OPEX. The other, of course, is in terms of credit cycles. The credit cycles are a lot more volatile in terms of wishes than most other jurisdictions. So to that extent, I think you got to look at it in the context in which Indian banks operate. And I think you'll have to look not just at NIMs, but again, net of expenses, net of credit costs. I think that's where I think we need to look. Actually,
I have those numbers, and I'll put that to the other two gentlemen before I come to you. Indian banks did have a problem of excessive, OPEX, branch-intensive banking. If you looked at the last 8 years, 7-8 years ago, you did find that their ROA, net of the treasury gains, because 7 years ago you had a lot of treasury gains. Net of treasury gains, the ROA was as low as 0.5 and 0.8, but today on an average it's about 1.2. So clearly returns have improved. Likewise, even if you looked at staff costs, they used to be 2.5 to 3% of total assets. Now they have fallen to 1.5 to 1.6. So Professor Ramohan, is it justified? At one point, yes, it was perhaps a more intensive cost, priority sector, all that imposing costs on Indian banks. But now clearly, this fascination or this obsession with 3% plus margins is unwarranted, isn't it?
If you look at the trends in net interest margin in the post-deregulation period for nearly about 10 years, it was almost static at about 2.8% of total assets. But in the last 3 years, we are seeing a decline. So starting in 2006-07, it fell to 2.6, and in the last year for which we have data, 2008-9, it had come down to 2.4%. So there is a declining trend in net interest margin, and one reason for that could be that earlier public sector banks, which really showed up the NIM, public sector banks had not woken up to the potential for fee income. Now that they have woken up to the potential for fee income, they are in a position to offer a lower net interest margin. So I think we are seeing the beginning of a trend, but this is not something that you can artificially accelerate, because there are fundamental reasons why the net interest margin in a context like India's may not come down for a long period of time. And I say this because you expect the NIM to decline with deregulation and greater competition and also with greater disintermediation. So as the financial sector evolves, you expect the borrowers to migrate to capital markets, so banks have to reduce the lending rates in order to keep them. You also expect the depositors to migrate to alternative capital market instruments, so you expect banks to hike the deposit rates. So for both these reasons, you expect the NIM to decline because banks are squeezed on both the sides. But in India, disintermediation has not happened. In fact, the opposite has happened. If you look at intermediation as measured by say the bank deposit to GDP ratio or the bank credit to GDP ratio, it has gone up enormously in the last few years. That is because when we started deregulation, we were an underbanked economy, and we still are.
Yeah.
So as the economy moves out of an underbanked status and more people are brought into the banking system, intermediation grows. And in the context of growing intermediation, you cannot expect to see too much of a decline in net interest margin.
Basically, you
I think you have to keep this in mind.
Well, that point can be taken, but partially also it appears that a lot of banks are able to make money simply because we are an underbanked economy. As long as you're underbanked and the demand is more than the supply, banks are able to get away with perhaps a higher lending rate. And in the NIMS average that you're referring to, Professor Rammohan, if you looked at the top, say 20 banks, private and public sector included, or top 15 banks, their averages have clearly moved higher, and they're all north of 3%. This average has been gets down probably because of some of the operators, but on an average, the top banks at least have clearly moved from a sub 3% to a 3% plus. But let me get Anindo on this argument, since he'll be better placed to compare Indian banks and foreign banks. Don't you think, Anindo, that bankers here are making away with more?
Lata, I'm just thinking of the margins that Indian banks have vis-a-vis other emerging markets. And I think that the 3% number is not necessarily very high when you put it in context of the kind of margins that Latin American banks have, or even banks in some parts of Asia like Indonesia has. And that possibly may have to do with the kind of the portfolio composition. But I also like to believe that it's perhaps the level of consolidation that you have in the banking system, competition that one of my fellow panelists had referred to, is probably also one of the reasons that account for somewhat higher margins in other geographies.
You mean there's lack of competition?
Indian market arguably is... I think Indian market is far more competitive, at least if you compare the market share of the top 5 banks, which is under 5, is around 40%
so
for
that
India.
Should drive down margins,
whereas
isn't
in a Latin American country, that's around 70 to 80%. So we see higher margins there, which is exactly the point.
Okay.
I mean, the margins could have been higher, but for the fact that there's more competition. In an economy like Taiwan, where competition is even more intense, net interest margins are under 1.5%. I think the other point I would like to make here is, and this was briefly touched upon, net interest margin is really the first line of defense that a bank has against credit cost. Now, I'm not sure whether on a long-term basis, the kind of credit cost that Indian banking system is reporting currently is necessarily an adequate reflection of the kind of buffers that the banking system should have against counter-cyclical situations. Partly reflected by the kind of specific reserves, loan loss reserves that the banking system has, which on an average is lower by many other emerging market banking systems. So without commenting on whether necessarily the margins are high or low, I think it's a good time to use some of those margins, and you pointed out that ROA at 1% is attractive, to use some of those profits to actually provide better in good times.
Okay. Just a little more forward-looking, Srini, do you think that our margins, is competition enough now to pull down margins in the quarters to come, or do you think it will be a while before that happens?
No, I think ultimately the market decides. I think our deposit costs have gone up over the last few months. Lending rates are going up, so there is clearly pressure on NIMs as we are speaking, and clearly these are cycles which we need to go through, and market will decide in terms of what NIMs we can live with. And that, as Dr. Rammohan was saying, I think the pressure is there for it to sort of nudge lower only over a period of time, over a medium term.
What's your sense, Professor Rammohan? You would expect that there are forces at work which will pull it down, or do you think that, considering that we are still underbanked, at least the top 10, top 15 will still be able to make much better margins than their developed country competitors?
Looking ahead, if you're looking at the trends in NIM, you have to see the changing composition of the loan portfolio. Now, as you get more and more retail loans, and as certain types of retail loans tend to predominate, like say vehicle loans or credit cards, or even loans made to small borrowers, you will see an increase in the lending rates and therefore an increase in margins. Now, if you're saying that MFIs can lend at 24%, which is the Malegam recommended rate, if banks were going to start lending to the same borrowers at say even 18%, that would be still higher than the rates that they are charging now.
No,
so as banks extend their loans to newer types of borrowers, and particularly retail borrowers, you will expect the lending rate to go up and therefore the NIM to go up. But that is not necessarily a sign of inefficiency.
Yeah, well, then are you saying that the Reserve Bank governor is unjustified in the demand he is making, or the request he is making?
Well, I think it's good for the regulator to be always on the side of the consumer and to seek a reduction in rates. I think it's appropriate for the Reserve Bank to take that kind of a stance and to keep the consumer's interest in view. But that should not be seen as some kind of a systemic defect or some sort of sign of inefficiency in the system. That is not substantiated by the numbers or the larger trends.
Okay. Well, Anando, surely global banks have a way more retail audience as well. There you often find the large corporates moving away from banks and completely into the capital markets. So, I mean, is it therefore just, even in spite of it, they have lower margins than Indian banks? I mean, developed country competitors. Is the Reserve Bank governor's, coaxing or moral suasion just because he's on behalf of the customer, or does he, or is there a justification that yes, these margins need to come down?
I think the Indian banks also have portfolio of somewhat higher, riskier pieces as well. Including lending to smaller industries or the smaller companies where the risk-return paradigm may be different. Also, I think when the governor had talked about lower margins, he may have been referring to the need for a higher deposit cost in the context of large or increasing loan-to-deposit ratios.
Okay.
So that may have been his perspective. In terms of the earlier question that you were debating on the trend for NIM for Indian banks, there's obviously a cyclical element to that, which would get influenced by the price of deposits and the bank's ability to pass that on to customers. And there's also, I think, a very encouraging trend in terms of the improving profile of the liabilities, including the low-cost deposits. So that, in my mind, is probably a crucial differentiator, going to be a crucial differentiator between banks as far as margins are concerned.
All right, point taken. We're running out of time. Professor Rammohan, Anindo, thank you very much for joining us. And I'm sure both of you will have made Srini very happy today that you defend the fact that Indian banks are not profiteering, but perhaps the NIMs are justified by the situation. We have to take a break on this note, but we will keep Srini for a bit longer. Another banker from State Bank of India will also join us, and after the break we will discuss with them whether the time has come to have only one signal